Commodities are one of the most volatile asset classes around. There's not many other assets that can go up sevenfold in a matter of months, which you saw in European natural gas a few years ago, and you've seen it repeated over and over again. It is quite volatile. So when you approach it, you have to be understanding the sizing and scaling of it.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here.
Welcome back to Gold for the 21st Century on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Greg Sharenow, Managing Director and Portfolio Manager for Commodities and Real Assets at PIMCO. We'll be discussing how policy uncertainty and inflation are shaping the investing landscape and the role commodities and real assets, including gold, are playing in helping investors grow and protect their wealth. Hello, Greg. Welcome back to Smarter Markets.
Thanks, Dave. Good to see you. Excited to be here.
Oh, it's great to have you here. It's great to have you back on the podcast. It's been a little while. And I wanted to talk with you because, of course, we've been talking about gold on the podcast. There's been a big increased investor interest in gold, commodities, and real assets over the past few years. Some of that interest in commodities and real assets has been driven by the role of particular commodities in the energy transition, and some of that driven by their role in providing inflation protection. So I wanted to ask you, from your seat at PIMCO, what have you seen driving investor interest in commodities and real assets today? What are you hearing from investors?
So it's definitely a mixed bag, in part because of the economic uncertainty that is out there. We are definitely seeing not major flows in the business in general right now because it's like deer caught in headlight. I would generally describe a lot of asset allocators, particularly international ones, which are considering what their exposure they want to have to the United States, and even US domiciled investors as well, like in terms of diversification. So in that context, inflation is certainly a big topic of discussion on when we think about like longer term portfolio diversification benefits of real assets. And certainly if you are experiencing, or you just went through your first major inflation experience in the last few years, a lot of investors found themselves genuinely short real assets. So particularly internationally, if you're a pension fund in the Pacific Rim area, like many of them thought that they would have a natural economic tailwind when inflation was there to their own economies, strengthening local currencies, and found themselves in the opposite situation where their currencies were weakening, the inflation was accelerating, there was no real economic growth. I think there has been a reevaluation to the various ways in which inflation could assert itself and negatively impact portfolios and portfolio balances. So that conversation is very much still happening. And we're definitely seeing investors interested in broad commodities as well as gold and real yields tips because of the level that they're at. But near term, like very locally, there's just tremendous uncertainty. And I think that is leading to not a lot happening specifically right now. Give us a couple months of settled policy, which doesn't appear to be in the offing. But like when we have that, I think we'll see where investors are willing to deploy more capital with a longer term view.
Yeah, I want to come back to the focus of international investors. But first, you brought up an interesting point of inflation can come from a number of different sources. It can be expressed in different ways. For many years, there was concern over the inflationary consequences of the Fed's zero interest rate policy, then a lot of the fiscal stimulus that came through with COVID. Now, of course, the US tariffs. How are you thinking about inflation and its potential impact on investor portfolios in the current environment? And how are your investors getting their heads around these different types of inflation and impacts?
There's an evolution that's going to occur kind of as information becomes solidified. We're now talking on the day where the courts effectively nearly completely overturned the tariffs that have been put in place outside of the 232 tariffs, which are done through a review process that looks at specific tradable goods to make a decision about that in the national interest. But the ones that were just blanket tariffs have just been reversed. And you could see that having meaningful repricing and short dated tips, which is basically another way of seeing that with no tariffs or lower tariffs than none, because you still obviously have the tariffs that are sector specific on, you're going to have lower potentially near term inflation. So there's uncertainty around this and the expectation that the Trump White House will look for new and alternate pathways to continue their policy is still very high, meaning that we do think that they're not going to throw up their hands and say, okay, it's passed, but give up. They're going to go and find alternate pathways, which we do think exist for them to have it. And near term, what that means is that we expect higher inflation than we would have back in December. In practical terms, that means like 3.5% to 4% PCE by the end of the year, rather than a high 2 number. We also expect lower growth, in part because of the tariffs, but also the sheer uncertainty that the tariffs are creating. So there's a real tension then when you're thinking about investing in real assets right now between a higher expected inflation and lower economic growth expected at the same time. It's not stagflation, but it moves in that direction. So when you're an investor and you're trying to figure out how to navigate that, like we always recommend, like think portfolio construction, have a longer term view. If you don't know what economic environment in, you can create a basket of real assets. You can have tips, gold, commodities, REITs, in terms of liquid. You could even have long FX exposure outside the US for like the import inflationary. I mean, there's ways in which you can do this in a pretty sensible way that enables you to not have to choose what specific economic environment you're in. So I think that's what we would recommend with all this uncertainty is to think about even a portfolio of real assets within the context of broader portfolio construction.
And how do you go about putting together that portfolio of real assets? You talked about some of the ingredients. How do you think about the mix?
Well, there's many different ways. It really depends a little bit on the liability or the risk that a client is looking to hedge and to manage. But when we think about it, you're going to have a very different volatility and inflation sensitivity of each one of those asset classes. So if you take commodities broadly, for example, empirically, if you calculate the return on a 1-year horizon to inflation surprises, so if you take the inflation forecast at any given point in time, you could either use the TIPS market to imply 1-year break even for what the market's empirically implying, or you could use a survey of professional forecasters that brings you all the way back into the 70s. What you'll see is that commodities have about a 7 beta. So for each 1% positive surprise in inflation, you would expect commodities to have 7% positive return, roughly. This is using the Bloomberg Commodity Index, a broad basket. Now, gold is meaningfully lower, just north of 1.5 to 2. TIPS is about 1. So if you really just want the most efficient short-term solution, you could argue that commodities would be it. But if you're in a poor economic growth environment and higher inflation, gold and TIPS might ultimately win. So a lot of the way in which we approach it is like on a marginal contribution basis, you equal weight them all. But that might not be the best solution for the capital efficient goals of an individual client. So we would work with them iteratively on that. But certainly, I don't recommend any one client to say, PIMCO or Greg says gold is going to here, so I'm going to choose gold. Because Dave, you and I worked long enough together to know how often our views like that are hard to get right. And so in that standpoint, like thinking about a broader basket can make a lot of sense for individual clients. Now, there are many that are just doing gold, and there are many that are doing broad baskets, and there are many that are doing tips, and then there's the other ones that are doing a combination. It really kind of depends on what the client is interested in.
And when you look at the client interest, and this brings me back to the international clients may have a different point of view than a US centered client. how much is there concern about the role of the dollar internationally? We talked a little bit about the deer in the headlights that many investors broadly are experiencing of there's so much uncertainty, you never know what the policy is going to be from day to day. So, people kind of waiting to get their feet under them. But is there also like a question of, is the dollar the safe haven that it used to be? And if it's not as safe as it used to be, do I need to look for some other real assets as part of my safe haven strategy?
Unquestionably, that these questions are being asked. And it's not just the value of the dollar, it's what the value of the treasuries that you're buying if you're using it for like a reserve, holding. You could see it in the steepening of the term structure of the rate market. The 30-year bond relative to the 5 and 10 years has weakened significantly. Part of that is obviously related to fiscal trajectory that we're on, but also there is real questions around the stability of the partnership and the policies that underpinned the US. Now, the US dollar is still the primary means of currency transactions and settling of global trade. It's still there, it's the maybe the best of the dirty shirts. It's still, in the sense that there's not many other places to put your money where you'll have the same quality and same certainty, but all you need is marginal changes in interest to have impact on relative pricing, right? So if you have more investors questioning if they want to buy US assets versus another, and you have a modest shift, it could have meaningful implications for the clearing price. And by extension, and part of what we wanted to talk about today is like gold. Gold, even small adjustments in how global central banks and pension funds and reserve managers and think about sovereign wealth funds are thinking about it. Small shifts have meaningful outsized implications at times. Like you can't have the global savings go 1% into commodities. That would overwhelm the market. There is a scarcity of safe assets or that one could have. But that's part of the reason why I think you've seen gold perform so well is because that question that you posed about, is there a question about the US centrality to global markets, the sanctity of the dollar? And there's other reason than just questioning, like the sanctions that happened on Russia, where their assets were frozen or seized. Like, do you want to have assets that you hold outside of the standard financial markets in the US? Maybe, yeah. And I think these are all the questions that are being asked.
Why don't we delve into gold a little bit? Obviously, continue to see new highs in gold, not asking you for the forecast, but what do you see as driving the interest? And I know the scariest words for investors is always this time it's different, but are there shifts occurring? Like you mentioned, central bank buying a 1% move can lead to a large change. Do you feel like we might be moving into a different environment for how people are thinking about real assets than maybe 5, 10 years ago?
Dave, when you and I were sitting next to each other in Goldman Research, we had sat together after 20 some odd years where gold was a dormant investment. Like in real terms, it was losing value for 20 years when we had inflation pickups or not. The price had gone quite a bit lower. Central banks, particularly European ones, were selling reserves. I mention that because we've discovered through some empirical research that we had done in behavioral research that your birth year can be a very high predictor of how you think about markets and lots of other things, to be clear. But like if you were alive and cognizant and waiting in the gasoline lines, you probably have a different view of the risk around inflation. Yes, I was on the tail end and did not see that. You have a different view on your expected equity returns and returns from fixed income. Like it's very informative. So like I'm starting that by saying I have never been a gold bug, right? Like my starting point was gold was a declining valued real asset for a long time. Then we had the ETFs come in and gold really accelerated in value as it became easier to access from a investable and financially accessible point of view. But gold reverted and ultimately started trading like a real asset. So the higher real rates go, the better return you can get above inflation for holding treasuries, the less need you have for gold. Right. And that kind of came like the governing. Now, 2022 was really sort of a major inflection point because one of the things that had been bothering me for a long time was our growing use of sanctions. because it just creates an incentive for alternate ways of avoiding them. If the US and Europe's influence over SWIFT, you create another system. Maybe cryptocurrencies are a natural offtake of that. But when we started seizing assets globally and the world clearly started moving into more dispersed camps of for political reasons, gold really sort of changed in my mind the nature of it, where it regained its luster for holding a physical asset. If before you owned a chateau in southern France with your yacht off the coast, maybe now you want to own more gold. And I think that was broadly something that has been realized by the ultra net worth families throughout the Middle East, Eastern Europe, Russia, and so forth. I think the value of the physical has also gone up for central banks who found themselves short real assets when inflation hit, want diversification from the US dollars, but also it's a hedge. I'm not just talking about China buying for their central bank or Russia. I'm talking about countries that are going to have to balance two, if not three, of these political forces, being the US being the third, and never knowing when you're going to run afoul of one or the other. And so I think gold, for the reasons of being a good real asset, for the fact that it did return well throughout the inflation period, now maybe not perfectly in 2022 and 2023 inflation, but if you look over the 5-year period, it's one of the best performing assets. So I think that's like crowding in some of the behavior, but also I think we have seen a bit of an inflection point where how reserve managers are thinking about it. So taking a step back and trying to answer your question, you and I in our research hat roles would have said, okay, we are at 40-year highs in gold in real terms. And as a result, you would expect the forward outlook to not be so rosy. But the way I've been thinking about it is that the kind of dollars that have been motivated to engage are really like the VLCC of crude. It doesn't turn real quick when it's going to its destination. It requires something meaningful to move. And that the behavior I expect to see is something like what we see in China's buying patterns of crude oil, for example, where they've been looking to build strategic reserves for a very long time. And when prices start getting high relative to, let's say, a 6-month exponentially weighted moving average, they start buying less. And then when it gets at that level or below, you start buying more and then buying a lot when you get discounted to it. And if that is a rising market, that where the point where they re-engage can be higher than where they stopped before, and other central banks as well. I kind of think you're going to start seeing that behavior. So said another way is that while it's certainly rich relative to any historical sort of valuation framework, I do think there's going to be an escalating number of buyers that look to support it in weakness. The way in which my view would really change is if there is something meaningful that changes in the political backdrop. But when you look at the fiscal bill being discussed and you look at the geopolitics and you look at the challenges that the world is facing today, I don't see a clear and obvious way out of it yet. So I think the support there is probably more durable than sort of any model would suggest.
And that long term behavioral shift is what I find most intriguing as a possibility, in that there's probably few assets that have a moniker like gold bug. Being interested in gold for a long time has kind of been shunned a little bit, right? Like you're a bit of a strange investor if you're really into gold, has kind of been the attitude. You're a gold bug or conspiracy theorist. What I find really fascinating now is almost this mainstreaming of gold, in that it seems odd to say that about an asset that's been around for many thousands of years, but it feels like it's kind of being pulled back into the mainstream of the financial system, of investor portfolios, where it's just stock, bonds, gold. Like, I want to have all of it. Are you seeing some of that attitude emerging where it's becoming more acceptable, not only to high net worth individuals and central banks, but kind of among a broader swath of the investors you work with?
Yes, it really is a function of a reevaluation of understanding how their portfolios are constructed. Remember when I said before that commodities have a 7 beta to inflation surprises? Well, US stocks and nominal bonds have a -2% beta. right? So like 1% increase in inflation relative to expectation means a 2% decline in your portfolio. And it could decline in both of your primary assets, right? So in that context and having that experience, I think, and the fact that it's the real first time in the better part of like 40 years where people saw that, hey, maybe we got too complacent in our portfolio construction. Yeah, I mean, they have to be thinking about it now. So, and there is definitely the, it's performed well, and I have to review and think about all assets that have performed well. But I think really it was the challenges in portfolio construction that was experienced that has accelerated the interest.
And when you look out, you had mentioned that many people, central banks, high net worth individuals, they want the physical. There's always been the thing in gold of some people just want the price exposure because they want the correlation in their portfolio. They might be happy holding an ETF, they might be happy holding futures. Others want the actual physical. They want to know it'll be there when they need it. How are you seeing the balance between those types of investors shifting, if at all, between those who want the physical and those who really just want the price exposure?
I don't know if I have a great answer to that other than the biggest dollar numbers we're talking about. The things that will move the needle the greatest are more likely than not to own the physical. It's nice to have Costco sell some coins and they're bringing a run on it. And I'm not saying it doesn't matter on the margin, but it's not quite the same. Because also, if you're going to own your own physical gold, you need a safe place to store it. And there's a lot of whether it be risks around it or whether it be costs associated with it for an individual. Owning it in your security account is considerably easier. But once you get into some number that I can never imagine having, then those costs and those risks become more manageable. So I think the physical interest in gold is going to be high, but I don't provide that exposure to clients. So, if that's the pathway that they're choosing, then I wouldn't see it directly. I may have conversations and everything, but I would never know what they're actually doing.
You've brought up the importance of portfolio construction and making sure that you have a well diversified portfolio, both within your real assets and across things like equities and bonds. And I'm wondering, as we talk about some of these changes that are occurring, whether it's the increase in policy uncertainty, the changing behavior of the dollar, are you seeing changing behavior of other asset classes or the way equities and bonds relate to each other or relate to the other real assets that's changing some of the thinking in terms of portfolio construction?
Yeah, I think there's a couple things I want to hit. So I apologize if this is like a slightly longer answer. The first being is that a lot of investors have had an interest in private real assets. And private real assets traded through the last inflationary cycle like a long duration, illiquid nominal asset. If you had a real estate portfolio you weren't able to sell, you weren't able to get any benefits from for years. So if you think that over a long period of time, 10 years, it will hedge your inflation risk because of the way the contracting and the resets and the general inflation feeds through, that's one thing. But if you were a portfolio manager and you needed to meet margin calls on or capital calls on your other private investments, or you wanted to sell a winner and to be able to buy some of the losers being the equities or nominal bonds, liquid real assets actually really stepped up in terms of its relative performance. And let's be transparent. I work at an asset manager. We like it when we manage more assets. But I work in an asset class where, frankly, I'm happy for our clients who are selling us and selling what I'm managing for them because it did what it was supposed to do for its portfolio. And real assets that were illiquid and private did not provide. So that's driving also a little bit of the conversation behind gold as well as commodities and tips, is because it is actually a liquid asset that one can trade and out of if they need to. But on the correlation point that's driving interest, I mean, modern portfolio construction is really based off of an idea or observation, kind of like how I mentioned my starting time was a good indication of how I think about the markets. Well, for 30 years or so, we were in a pretty benign environment inflation wise, and stocks and bonds had negative correlation. So you were naturally diversified. But if you go back over a longer period of time, that was not always the case. In fact, it was more of an anomaly where you would have fixed income and equities being negatively correlated. It was an anomaly rather than positively. So starting today with real yields and nominal yields at 15 years highs, 220 basis points or, 10-year real yield, like that's very attractive. In some respects, we think that that's going to lead to the comeback of the 60-40 portfolio. Like it may not have worked like you wanted it to, but like there's redemptive features of the new starting point for where real yields are. Instead of being -100, they're positive 220. Like you're probably going to have a better experience. When you have the economic threats that you have today, it definitely makes a little bit more challenging. And that's where we've seen the concerns around the fiscal budget, concerns around tariffs leading to positive correlation again between traditional fixed income nominal and equities. And real assets have outperformed. Like even if you look in the commodity space and you look at the ags index, you look at the industrial metals index, you look at the precious metals index, they're up on the year. And obviously precious metal being the shining, no pun intended, the leader of the group. But so only energy has really been down in this period. So commodities did actually provide some diversification right now. The last thing I would note, sorry again, I promised a long answer and I'm delivering. The correlation to the dollar. You and I discussed this many times before about like it's unstable at best. And it really is fact dependent about where the growth is, what's the nature of growth, what's the supply, is it a supply shock? And the US obviously has changed massively its energy balances with not being like a net energy exporter. That lower prices ironically lead to lower capex for oil. And as a result, it has some negative impacts on the US economy as well. But when I think about this environment, we've definitely seen gold trading with a negative correlation to the dollar and some other commodities as well. I don't know if that's durable. This could be just right now we're in the peak uncertainty phase of whether or not the US is a good investable arena, a good investable space. But that's something I'd be keen to see how it evolves over the coming year or two to see if that continues to be so negatively correlated, because that wouldn't be my starting point assumption.
It's very interesting to me to think about in terms of where we go from here. Is there a bit of a can you put the toothpaste back in the tube problem where once people start to question, is their money safe in US dollars or could it be subject to some sort of sanctions? So we need to hold it somewhere else. Or, you know, is US policy going to be erratic instead of predictable and principles based? Can we go back to the way it was, I guess is the question. Or do we have to realize, okay, certain things that were kind of taken for granted by investors may just be different from now going forward. And so our behavior is going to have to be different. And I think it's probably still very early innings in people thinking about that. And I guess my question would be, do you have a sense of, are people still kind of thinking we're going to go back to the way it was? Or are they really thinking, okay, new environment might be this way for quite some time. Maybe I just need to shift. It's a big question, but just curious for your thoughts.
So I think there's the center of the debate is what you can try to focus on, because that will proceed across different administrations and different times. So you look at the view on immigration and how that politics has moved from the center, has moved more to the right, if I have to put a left-right spectrum. I would say tariffs have also had a pretty big change in the way in which both left and right. Now, there's obviously a lot of legislators who oppose the idea of tariffs in both parties, but there are also, if you look at Bernie Sanders, for example, on the left, as an example of a leader on the left, he's supported and some directed tariffs, maybe not blanket, but like specific tariffs on specific industries or specific countries. The consensus of China being a bad actor is very high as a result. You didn't see Biden changing the Trump 1.0 path with regards to tariffs and policy on China. If anything, they had a continuation in this steepening of it with technology, export controls, and so forth. I think those are examples where the center of gravity is moving. Now, that center of gravity to me is one in which the US has more of a multipolar world to operate in than a unipolar. And that tariffs are going to not go away from the conversation anytime soon. If that's the toothpaste that has to go in the back in the bottle, at least for the next 3 years and 8 months, that's going to be a very much a center because it's something that our President Trump truly believes. So in that context, I think investors do have some information, but they can really think about how to set up their portfolios. Lower migration is, a reason why we think that there's some inflationary pressures potentially in the US. So when you think about real assets, that's there. When you think about tariffs and which is part of the reindustrialization of the US and higher spending on military industrial globally and higher spending on artificial intelligence, which is a massive energy and materials intensive endeavor. Like these are things that are things you can say with reasonably high level of certainty or is the background that we're operating under. So in that context, coming back to really the first question you've asked and the whole subtext of this conversation is that real assets have climbed up the ladder of interest, even if the near-term economic uncertainty is very high. But because in the long term, you want to build a resilient portfolio and we can identify with the singular, maybe overarching the idea of deglobalization as being ultimately an inflationary output.
And while everyone gets very focused on tariffs and trade policy, when you're looking across the real asset space, are there other, for lack of a better word, narratives or stories or themes that you're saying across the space that you think are also important that people understand right now?
So I think there's a couple ways to think about that answer. One kind of advice is to investors or not to think about, like not to chase inflation when you see it, but rather be positioned ahead of time and prefer. And that's an overarching view that and conversation. With regards to how to do that, another popular question we get is how do you think about natural resource equities versus commodities itself? And one thing you can say from 2000 to 2020, you were unquestionably better off investing in the commodity betas and equity index replication of the commodity companies rather than owning the natural resource equities. Said another way, natural resource equities destroyed value relative to what their betas to the broad markets would have been for commodities and equities. I think the change in their C-suites, partly driven by a shrinking investor base, whether it be ESG and environmental related, or whether it be we burned too many people for too long. And as a result, we have a lower level of investor interest and we have to prioritize return of capital and return on capital over growth. I think is making these companies better today than would have been. And their balance sheets are stronger than they've been in. And, when I joined in the late 90s, I remember the industrials and energy equity analysts lamenting the lack of interest in them because how staid and boring the companies were relative to all the internet stocks. And I think in somewhere like being back in that world it makes them better investments. Now, they do have a big equity beta though. So if you're worried about an inflationary shock that leads equities lower, it's not nearly as effective, but the companies are better. The implication for commodities of that is they're investing less than they would have otherwise. If they used to invest $1.20 of every free cash flow and they're now investing 70 cents, it means you're going to have less growth for the same, commodity prices.
You brought up some good advice, Greg, and I wanted to close out today by asking you, because you have a lot of investors out there who are looking to commodities and real assets for the first time or for the first time in a long time. Is there any other additional pieces of advice you'd give to people who haven't really looked at commodities before or it's been a while?
So one, know why you're engaging. Really understand the horizon and the reason. Two, I'm biased. I've been doing this for 20 years as a portfolio manager. I think there's tremendous room to outperform a lot of the vanilla expressions out there where you just own an index of commodities or a single commodity. I think there's a lot of ways that value can be added to an investor that can improve upon the experience. But I think the bigger overarching thing is when you want to make the investment, understand why and the duration. So if you're trying to hedge your inflation, investing in periods with low inflation might actually be the best answer. And history has proven that. And the most recent inflationary episode was very specific example of it, where commodities rallied more than doubling and inflation went up by 6, 7, 8 percentage points from the low. That was a very traumatic experience for equity and nominal assets. And there was a reason why investors had gold, commodities, and other real assets in the portfolio to help manage that environment. So I just encourage that to be pretty sober and clear-headed, because this reality is, outside of like the Mag 7, commodities are one of the most volatile asset classes around. There's not many other assets that can go up sevenfold in a matter of months, which you saw in European natural gas a few years ago, and you've seen it repeated over and over again. It is quite volatile. So when you approach it, you have to be understanding the sizing and scaling of it.
Thanks again to Greg Sharenow, Managing Director and Portfolio Manager for Commodities and Real Assets at PIMCO. We hope you enjoyed the episode. We'll be back next week with another episode of Gold for the 21st Century. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here. Contact us at sales@abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.